All right, folks, we'll go ahead and kick things off. Thank you, everyone, for joining us for today's webinar. My name is Gary Sarkisian, and I'm the Director of Education and Content at CFA Society Boston. In a moment, I'll be introducing you to today's speakers, but first I wanted to make some quick comments regarding the current environment as it relates to educational programming here at the Society. First off, our thoughts and prayers go out to those who have been directly affected by the COVID-19 disease, as well as the medical professionals who tirelessly work on the front lines of this epic battle. We hope all of you are staying safe and healthy. Up until recently, live in-person programming was the primary delivery vehicle of education here at the Society. Now we're in a different environment and must adapt to virtual forms of communication for the time being. That said, webinar technology will actually enable us to reach a much wider audience than we had with live programming. As a case in point, today's presentation was originally organized as a live event in a venue that would have supported roughly 50 attendees. Now, thanks to the virtual format, we have almost 400 people registered to watch this live stream, some of whom are located outside the US. In addition, we welcome members of other CFA societies who join us on our live webinars. Registration to our webinars will be free to both members of CFA Society Boston as well as members of other CFA societies. Finally, I can't emphasize enough that our members are one of the most important resources for the Society. We appreciate your continued feedback regarding our educational programs, welcome new ideas from you, and encourage you to maintain communication with your fellow members as well as Society staff and volunteers via our online community, Connect. Now, I'd like to move on and introduce you to today's presentation. Over the last few decades, quantitative investing has attracted both a sizable following among investment professionals as well as assets under management. In fact, according to hedge fund research, in 2018, assets invested in quantitative hedge fund strategies approached the $1 trillion mark. Furthermore, traditional active managers facing stiff fee competition and weak fund flows have also grown in this area and in some cases have replaced their human investment decision makers with automated rules-based trading. Perhaps coincidentally, during the last 30 years, whether through textbooks, university courses, or written research, the academic world has also touted claims that applications of Grinold and Kahn's fundamental law of active management may add investment value to optimized strategies, even when only a small informational advantage is available. However, in a forthcoming paper in the Journal of Investing, our speakers present important new research on the likely limitations of various active quant investment strategies. They show that many popular strategies associated with Grinold's theory are likely unreliable and self-defeating because of estimation error and constraints from practical application. They further show that far more information than commonly assumed and an appropriate portfolio structure are likely necessary for outperformance. It is my honor to introduce our speakers today, Dr. Richard Michaud and Dr. David Esch of New Frontier Advisors. Dr. Michaud is the president and CEO of New Frontier. He has earned his PhD in mathematics from Boston University and has taught investment management at Columbia University. He is author of the book Efficient Asset Management, a practical guide to stock portfolio optimization and asset allocation. In addition, he has authored over 60 published journal articles, manuscripts, and white papers. He is co-holder of 4 U.S. patents in portfolio optimization and asset management, a Graham and Dodd Scroll winner for his work in optimization, a former editorial board member of the Financial Analyst Journal, associate editor of the Journal of Investment Management, and former director of the Q Group. Dr. David Esch is the managing director of research at New Frontier. Dr. Esch completed his PhD in statistics at Harvard University in 2004 and earned his master's degree in mathematics and statistics from Boston University. His specialties include mathematical statistics, numerical analysis and computation, Bayesian statistics, and econometrics. He is author of the article Non-Normality Facts and Fallacies, which appeared in the Journal of Investment Management and was selected as one of the best papers of that journal for 2010. He is also co-author of many other peer-reviewed journal articles. Now, before I turn over the presentation to our speakers, please note that your lines will be muted for the duration of the presentation. At the end of the presentation, we will be taking your questions for Q&A. Should you have any questions for the speakers, please feel free to submit them at any time during the presentation using the chat feature for GoToWebinar. So without further ado, Dick, please take it away.
Thank you very much, Gary, for your kind words. We at New Frontier are very proud to be pioneering with the CFA's Boston Society online presentations that are not only available for local members, but also nationally and beyond. So my purpose here is to present a new paper, The Estimation Error and the Fundamental Law of Active Management is Quant Fundamentally Flawed. It's co-authored with David Esch and Robert Michaud, and it is slated to be published soon in the Journal of Investing and is currently available right now in preprint form on ResearchGate and SSRN. So Grinold's fundamental law has been called the canon of active management. It is often used as a framework for rationalizing and for marketing various optimized investment strategies. Iconic examples of the published research include Grinold and Kahn, 95-99, and Clark, De Silva, and Thorley at 2002 and 2006. Grinold and Kahn claim adding stocks, factors, trading frequently can often add investment value to an optimized or quantitative investment strategy. And Clark, De Silva, and Thorley claim reducing constraints can often add investment value to an optimized investment strategy. Grinold theory has spawned an enormous body of published research, rationalizing various institutional quant strategies for more than 25 years. A lot of people made a lot of money on this. So the extensions include, and these are just partial lists, Michaud, Quant, and so on. There are a number of industry tutorials on the internet, Kahn, Kroll, and so on. There have been many teachings, both academic and professional conferences, and top university academic courses, as well as courses at CFA Institute and Nikaya Group. And there are the idea has been in the textbooks in Foucault and Fabosi, Jacobs and Levy, and others, and many quant strategies and practices are applications of the Grinold theory, hedge funds, long-short, leveraged alternative strategies. So we will show that the fundamental law is not useful as a framework for asset management and practice. We will start with an intuitive discussion followed by a comprehensive simulation study. And we will conclude that the applications are likely, unreliable, and self-defeating. And the reason has to do with Grinold theory, ignores estimation error in optimized portfolios, that's Michaud 89, and constraints required in practical application, and Markowitz 2005 is one of the best references. The limitations of the law may have been a very significant factor in the inability of many quantitative investment strategies to show superiority relative to passive management. This is an active-passive debate. So, index relative mean variance optimization is a framework of choice for designing active optimized strategies. Benchmarks arise naturally in active management for defining investment goals, for judging and manager competence. Active managers typically claim that they can enhance return relative to a given level of residual or index tracking error risk. The information ratio is the objective. It is the estimated return relative to a unit of residual risk. It is a very convenient framework for defining active investment management. And so this is the world famous formula here. The Grinold formula describes a decomposition of the mean variance optimization, of the information ratio. So the maximum of the information ratio is approximately, and it's a pretty good approximation, of the information correlation, the correlation between ex ante and ex post return, your forecasts and your actual, times the square root of the breadth. The breadth is the number of independent sources of information. And it's very important for me to say this, it's a sum to one or budget constrained optimization. So what this formula says is very, very benign, really. Active management is a combination of skill and investment opportunities. How could anybody argue with that? Okay. Well, let's look at the Grinold and Kahn paper a little bit more, textbook actually, more closely. So what they say is that a manager may have a relatively small amount of IC of information, but the performance can be enhanced simply by increasing VR. So you hold IC constant and you just increase VR. The message is clear. It takes only a modest amount of skill to win as long as that skill is deployed frequently and across a large number of stocks. That's a quote, but from both editions of the text. So the implication is you can increase the size of the optimization universe, and they have been responsible for people not only to optimize 500 stocks or 1,000 stocks or 3,000 stocks or 10,000 stocks, sometimes really a great deal of number of stocks, or adding a number of factors, are trading very frequently. So the key assumptions here to the theory is independent information and the IC constant for additional breadth. The Cox-Silva-Thorley is a kind of companion article here. They generalize the Grinold formula to introduce what they call the transfer coefficient. It's a number between 0 and 1. So the transfer coefficient is a measure. It's a measure of how information is transferred into the optimized portfolios. And you don't want a large transfer coefficient, because according to them, it reflects a reduction of the information in alpha due to the presence of constraints in the optimization. They counsel reducing constraints to let the information flow directly to the alpha. This is a very widely influential article that is often used to promote not only quant, but hedge funds, long-short strategies, absolute return strategies, and many alternative fund strategies. So our roadmap will be intuitive discussion, followed by Monte Carlo simulation optimization with estimation error. We will look at the optimization universe size, and we will look at equal weighting, budget, and sign constraint portfolios, and we'll pay attention to the differences between theory and practice. Our simulation results turned out to be very nicely generalizing the classic estimation error studies in the literature. Johnson and Corky, Frost and Savarino, and do a very nice job of rationalizing the empirical study de Miguel et al. We conclude, applications of the Grinold theory are likely unreliable and self-defeating in practice. So let me focus on Grinold and Kahn. Okay, again, it takes only a modest amount of skill to win as long as that skill is deployed frequently and across a large number of stocks. And so they decided to try to rationalize what they're doing in terms of a roulette game. Now, a roulette game in a casino has a positive probability of a winning play for the casino. It's very small, each play, but it's always a positive probability. And of course, more plays lead to the likelihood of more wealth for the casino, of course, not for you, okay? It's a paradigm for rationalizing the applications of the law. But there's serious limitations of this roulette game rationale, and it really goes to the heart of the problem, actually. The probability of casino winning is known, it's positive, it's constant. The probability of an investment game winning play is unknown, unstable over time, may often be negative. So increasing investment plays may often not be desirable. The rationale is not valid, but perhaps it was just an interesting way of talking about what they do. So let's continue with some of the more serious issues. So GK proposed increasing the number of assets to add breadth, but of course the investment value needs to be conditional on keeping the skill level constant. So that's one of the key issues here. Now consider an analyst covering 20 stocks now asked to cover 40. That often implies that the analyst's overall average information is probably less reliable than it was before, because average IC and universe size can often be negatively correlated in practice. The bigger the universe size, maybe the smaller the average IC. So the theory does assume that the skill level is constant. So this is really not the right way to think about it for a lot of reasons. But the point is that naively enlarging the optimization universe may often be self-defeating. So if you're doing a large stock universe index relative optimization, you're probably going to want to use factor valuation for forecasting alpha. And you won't want to look at individual securities so much, okay? So what Grinold and Kahn propose is increasing the number of factors to add the breadth. But choosing forecast factors that are reasonably uncorrelated and significantly positive is no simple task. I wrote a monograph for the CFA. It's now on ResearchGate, and you can find it. It's actually finding an awful lot of readers recently. Many of these factors may be highly correlated, and many of them are totally insignificant. So factors are often chosen from a small number of categories: value, momentum, quality, dividend yield. There's a list, okay. Once you get past 10 of these factors, you can't really find very many that are reliably significantly positive and so on. Breadth is often limited independent of the stock universe size, whether you have 100 stocks or 5,000 stocks. Naively increasing factors may reduce not increasing IC. I used to know a manager here in Boston who had 50 factors, and I was wondering why it is that his forecast didn't seem to work very well. Invest often is one of the other prescriptions. So they propose trading more often to add breadth. So investment strategies typically have a natural trade frequency. Now that's really important. Well, there's an asterisk there that says, I'm not talking about high frequency trading. High frequency trading is really more closely associated with pattern recognition algorithms. So it's not the same character of the issue here. So if you had a book the price manager or earnings the price manager, they were likely to be reluctant to trade much more often than a month or a quarter because the information is not really very fresh until then. And a deep value manager, some of them exist here in Boston, are reluctant to trade much more than once a year or once or twice a year. Many deep value managers don't trade that often. Growth stock managers may trade more often, but they don't trade that much more often. So more frequent trading than natural is often infeasible or even suboptimal. You may reduce effectiveness while increasing trading costs and making the brokers rich. Of course, you might get some favors back from them, but they are limited by constraints relative to investment style. So then there's Clark, De Silva, and Thorley. Okay, they propose removing constraints to add investment value. But optimized portfolios typically include many linear constraints. Now, some constraints may be cosmetic for marketing purposes, but many constraints are necessary in practice. And the world's authority might have something to say about this, Harry Markowitz. They may manage the instability of the optimizer, the ambiguity of the solutions, the poor diversification of the solutions. Some constraints limit liability risk, which is often an institutional requirement. You can't get away with it. Even the largest financial institutions have leveraging limitations, and performance mandates often impose risk constraints. So let's go to the issue of how to decide whether something is useful or not. Now, backtests. Typically used to demonstrate the value of a proposed strategy. Backtests are, some people call them horse races, where they kind of start from a point instead of going backwards, have the virtue of practicality, but they have no reliable prospective information. They are always period-dependent results. They only show what happened over some time period. Paul Simon has said, 100 years, it's just another 100 years. Who knows what's going to happen the next, okay? So my personal experience in this business is backtests are notorious for misleading investors, for leading to a loss of wealth, a loss of careers, and a loss of firms. Serious limitations of any backtest. Think about Frank Knight to 1921. Unreliable evidence for factor or strategy in practice. So what I want to do now is talk about a rigorous testing framework for optimized portfolios. A simulation test framework. And if you're not familiar with this, I think everybody should want to try to get familiar with it. So Harry Markowitz uses it now as well. So the referee knows the true risk returns for a given set of securities, the true risk returns. The referee computes the Sharpe ratio of the maximum Sharpe ratio optimal portfolio for the data. So now we know what the maximum Sharpe ratio of this data. Now the simulation test is a player receives the simulated returns from the referee. Now notice that simulated returns do need to know what kind of return distribution you're using. So normally you use a multivariate normal distribution, but it's not dependent on that. But anyway, these are simulated returns associated with the referees and data. So the player computes these risk returns, mean variances and correlations, the maximum Sharpe ratio optimal portfolio for the simulated data, and reports the portfolio back to the referee. Now the referee scores the true Sharpe ratio for the simulated maximum Sharpe ratio portfolio. And then that whole procedure is happened again, another set of simulated returns, another test, and so on. So the procedure is repeated many times. So the referee averages the true Sharpe ratio for the simulated maximum Sharpe ratio portfolios. And so the average Sharpe ratio for whatever the optimization is doing is used to compare performance for each strategy. This is a very, very powerful test. The classic estimation error study of the budget constraint mean variance optimization is Jobson and Corky. I believe they are the first ones to actually provide a simulation test in modern finance. So in their study, they do a Monte Carlo simulate 5 years of multivariate normal returns from historical data they chose for a universe of 20 stocks. So the referee scores the true Sharpe ratios of the simulated maximum Sharpe ratio mean variance optimal portfolio. And then they also score the Sharpe ratio of the equally weighted portfolio. So these are the results of this very famous study. The optimal Sharpe ratio, the one for the referee, is 0.32. The equally weighted Sharpe ratio is 0.27. The average of the optimized Sharpe ratios are 0.08. The average simulated Sharpe ratios are 25% of the true value. These simulated optimized portfolios, many of them, this is the average, right? Many of them are buried in the x-axis. Equally weighted is far closer to optimal than optimized. They conclude that the budget mean variance optimization is not recommendable for practice. This is an extremely prescient paper. By the way, for those of you famous, which are knowledgeable about the Sharpe 1964 capital asset pricing model paper, these results are the same as applied to expected utility maximization in Sharpe 1964. And what you're seeing from Jobson and Corky is equally weighted, is superior to the theoretical framework in capital asset pricing model. It's a small study, but that is what it says. Now, one final thing I wanted to, before I want to turn it over to David, there's another very famous and wonderful paper, Frost and Savarino in 1988, and they extended the Jobson and Corky simulation study, so they now use not a 20 stock universe, but a 200 stock universe. And what they've contrasted it now is not a sum-to-one constraint optimization, but long-only and more restricted constraints relative to equal weight. So look, you do long-only, and then you restrict it to 5%, no more than 5% for each security, no more than 4, no more than 3, no matter 2, all the way until you get to maybe equal weight. What they found, up to a point, but what they found, that the more constraints you have, the higher the average Sharpe ratio. That's completely the inverse of Clark, De Silva, and Thorley, where they recommend reducing the constraints. Frost and Savarino find that constraints add to the average out-of-sample Sharpe ratio. Constraints are like Bayesian priors on portfolio structure. They mitigate estimation error by forcing the simulations towards more likely optimal portfolios. And Jobson and Corky and Frost and Savarino directly contradict the Clark, De Silva, Thorley claims for two very different sized stock universes. And then we will come back to all of this. And now I'll be pleased to send all of this to Dr. David Esch, the optimization dimensionality issue.
Okay. Thank you, and good afternoon. Welcome. I'm going to present some details of our simulation study, which follows in the footsteps of the landmark Jobson and Corky, Frost and Savarino studies and examines dimensionality issues related to optimization. So what are the objectives of our study? We wish to study the impact of estimation error on several optimization procedures relevant to the fundamental law, of course, across a range of different breadths and different ICs. So specifically, we are interested, following in the footsteps of the Jobson and Corky, of examining situations under which optimization is a worthwhile pursuit. And what we mean by that is that it increases the expected information ratio over a baseline, such as an equal weighting procedure. Because if you can't beat equal weighting, then optimization has no investment value and is not advisable. So, of course, we're interested in the functional relationship of breadth and information ratio. Is it a square root rule like in the fundamental law, or does the curve level off a little bit as breadth is added to the system? We're interested in studying constraints because we have these two conflicting results from the Clark, De Silva, and Thorley, who claim that constraints damage the average performance against the Jobson and Corky results, where constraints to a point were helpful to the out of sample performance in terms of information ratio. And so, of course, we're interested in studying these things across various levels of IC. So I'm going to say right now that the concept of information coefficient, or IC, is related to estimation error in a certain way. Because if you think of estimation error as noise, increasing the noise of the system has a tendency, all else equal, to reduce the information because it's lowering the signal to noise ratio in the system. So we're going to study the full matrix of different treatments experimentally and how they interact with each other. So our master data set was taken from listed stocks on the New York Stock Exchange. We required a 20-year history of contiguous monthly returns spanning from 1994 to 2013. We found 544 suitable stocks. This may be optimistic in terms of restricting ourselves to these stocks. This may create a little bit of optimism in our results, and you'll see this is a theme of our experiment. But we would rather be optimistic about all of these procedures than to have a critical reader be able to assign blame for underperformance to some other cause than just the differences among the different optimization procedures. So what we're looking for out of our master data set is the referees table of expected returns and a full rank well-conditioned covariance matrix. So to get a full rank well-conditioned covariance matrix, we use a famous procedure, Ledois and Wolf 2004, which mixes together a factor model with the sample covariance optimally and produces a good estimate of covariance that is full rank and well conditioned, but also has reasonably well targeted and plausible estimates for our list of stocks. So we do believe that our master table is, fulfills its mission in terms of being representative of what real equity optimizing looks like, and as well as matching the theoretical considerations in the studying the characteristics of, the operational characteristics of the fundamental law. This data set is available online, and we will be publishing the URL for that in the paper. So anybody who's interested can play around with the data and perhaps conduct another experiment as a follow-up, just to make sure we're on the right track. So let me describe our simulation framework a little bit. This is a sort of recipe or a simple version of the algorithm that we followed for doing our experiment. Steps 1 to 3 on this page are each simulation. So steps 1 through 3 are repeated many times. So the first step is to draw a list of 500 names from our master data set, and those are ordered. So we create lists of, say, the first 5, the first 10, first 15, and steps of 5 up to 50, and then in steps of 50 up to 500, so that we have a nested optimization universes where each size universe is contained inside the next larger universe. But from the full list of 500 names, we simulate some returns from a multivariate normal distribution. And so we pass that block of data along to each of the players in our simulation framework. And the players represent 3 different optimization treatments. So trivially, there's the equal weight player who just passes back 1 over the sample size for each of the sample sizes that I just detailed. And then there are 2 optimizers, two optimizing players. One of them is budget only constrained, so they're allowed to have long and short positions in their portfolios. And the other one is sign constrained, so that's long only, because we're interested in studying the impact of sign constraints on the referee scored or out of sample performance of each of these players. So we're adding assets without replacement, that's in sequence of nested. That produces a nice increase in breadth because we're adding stock specific information as the size increases. So after the players all create their best portfolios, maximum Sharpe ratio, at least what they think is the maximum Sharpe ratio portfolios, they pass them back to the referee and they get scored with the true parameters under the simulation framework, so that it's an honest score and reflects the out of sample performance in the simulation framework. So we repeat this thousands of times in thousands of different permutations of all of the names that are in the master data set. And we average across those, and then we can make a chart and plot them on a graph and compare how the procedures did. So one hurdle in the study design for this experiment that we had to overcome was the covariance estimation problem. You may have noted that our master data set has 288 time periods, but many more than that stocks. Many of our simulation treatments for the players, the block of data has many more assets in the universe than time periods with which to estimate the covariance. So the sample covariance matrix is out, but fortunately that's not a problem, since practitioners of equity optimization generally use factor models to estimate their covariances. However, there's a lot of disagreement about the right factors to use, the right numbers of factors, which models, exactly how to do that. And we wanted to avoid any possibility of blame for underperformance on the covariance estimation procedure, because people that don't want to believe that one optimization method is doing worse than equal weighting or doing worse than another one are going to say, here's a possible cause for that underperformance. So we wanted to avoid that. So our workaround was just to give the players, the referees, covariance matrices. So what that means is that we may be overestimating performance, but you can think of our results as upper bounds. We tend to err on the side of optimism for this simulation experiment because we don't want to be able to assign blame to other causes than just the treatment differences. So for each combination of breadth, constraint treatment, and we also present a fourth curve. So we have the equal weight, the two optimizations, and then we'll have the reference curve, which is the no estimation error case. So this is what the referee knows to be the maximum Sharpe ratio. So as Dick was saying before, there's an analogy of a roulette game. There's a known probability distribution of the outcomes when you know the real return distribution for optimization. And so the best strategy for that is well known. It's simply budget constrained mean variance optimization. This particular case is equivalent to the Grinold assumptions in the fundamental law, but it's also highly unrealistic in practice. It's unattainable in practice. So one thing that I haven't addressed is how we targeted a particular IC in the experiment. So as I mentioned before, information coefficient is identified somewhat with estimation error itself. So by varying the amount of estimation error for each trial in the simulation experiment, we can vary the realized IC for that. And so the way we calibrated this was by taking the entire master data set pool and simulating from that and computing an IC by computing the correlations with the referee and then averaging over many simulations of that to get a Monte Carlo estimate of IC by sample size for the data set. And then we choose the number of simulation periods, the number of time periods in each simulation that most closely matches the target information coefficient. So the target information coefficients were not attained exactly, but they're very closely approximated. They're generally within 1%, even for the small optimization universes. So speaking of averaging, I want to also mention that averaging over every permutation of the assets in the master list of stocks in our data set means that every asset has an equal chance of occurring first or last or not at all in every simulated data set. So assets, some assets may have more information in their simulated data than others. If a highly volatile asset may have very little information in its simulation, for example. But because we're averaging across every permutation of the data, we get a nice, smooth, linear model of additive breadth for our experiment. Some people may be concerned that you're adding more and more assets to the universe, that the breadth is not increasing as you're adding more assets. But for our experiment, that is not the case. We have examined this very closely, and we're quite confident that we have a smooth linear input of breadth for the experiment. One final note from me before I turn the floor back over is that ICs greater than 10% are not formally consistent with the proof presented in the original Grinold paper and in the Grinold and Kahn text. There is one step of the proof where there's a series that has to be approximated, and so they make that assumption. But for our experiment, we found it extremely illuminating to examine ICs greater than 10% because we want to know just how much of a boost you need to give, how much more information or how much less estimation error is needed to boost the different optimizations, both with respect to equal weighting and with respect to the no estimation error case, but also with respect to each other. So is there a crossover point where the budget constrained optimization will actually outperform the sign constrained optimization? We know there probably should be a crossover point if you add huge amounts of information to the system, but those, although they may not be realistic for practice, we found it very interesting and illuminating to look at those things. And so this concludes my summary of some of the methods in our experiment. And with that, I am going to pass it back to Dick.
Thank you very much, David, for this very clear and detailed presentation of a simulation test. So now let me go back to performance. Excuse me. So the performance will be displayed in figure 1 with 3 panels. The 3 panels are corresponding to 3 levels of information. Point 1, point 2, point 3. The graphs are of the average Sharpe ratio as a function of the size of the optimizer universe. There will be three optimization protocols that we've been describing: a budget constraint or sum-to-one constraint, a sign constraint. The budget constraint, by the way, remember, it can be long and short, right? Sign constraint and equal weight. So each graph is an average of the Sharpe ratios for universes up to 500 assets, each value from 16,000 samplings, and most importantly, in terms of trying to capture breadth without replacement. So there will be a 4th graph, that is the Grinold theory case. It'll be budget constrained, as it is, the way it's defined, 100% certainty, the roulette game framework. And so here it is, okay? So as promised, we have 3 panels. The first top panel is an IC of 0.1. The second panel is 0.2, and the third one is 0.3. So increasing amounts of information. The y-axis is the average Sharpe ratio for the particular strategy optimization, and it is a function of the number of stocks in the optimized universe, which in our case is the number of independent sources of information. So the green curve is the Grinold case. It's the Grinold and Kahn case. It's a roulette wheel case. It's no estimation error. So as we simulated the fact of having a no estimation error where the mean is known and the standard deviation is known, then of course what you would see, and that's what of course is predicted by Grinold, is as you increase the breadth of the strategy, it increases the amount of information. The Sharpe ratio is a function purely of the number of independent sources of information, or in this case, the size of the optimization universe. So it's exactly what the theory says, but it's only for no estimation error. Now, these are sum-to-one constrained portfolios. Now I'm going to go to the cyan curve. The cyan curve is exactly this theory with estimation error. That's the only difference. We're using simulation now to capture alternative returns, not knowing exactly what the mean and the standard deviation might be. It's certainly the mean. So the sine curve is a tremendous contradiction to the theory. The average Sharpe ratio of an optimization with estimation error. By the way, you cannot ignore an estimation error in optimization. This is not an option. This is in practice. The theory is not confirmed. This is an enormous contradiction to the theory, at least under the condition of 0.1 IC. And by the way, that is the assumption used in the Grinold and Kahn text. The red curve is the equally weighted curve. Now, the equally weighted curve is superior to the optimized portfolios with estimation error. That's exactly what Jobson and Corky said. They did it for a 20 stock universe, a small universe. But you can see that in our generalized version of these simulation studies, look, it's true for just the entire range of stocks in this optimization universe. Okay. And then you have the sign constraint solution, which is superior to the equally weighted solution for most of the breadth, okay, if you have enough breadth, and very much more superior. And then the out of sample simulated, budget constrained simulated portfolios. So the Grinold theory has to do with sum to one optimized portfolios. It is an application of the capital asset pricing model. If you go back to Sharpe 1964, the capital asset pricing model theory is based on an optimization that is exactly this optimization, with no sense of estimation error. But if you include estimation error, then what we see is a dominant theory of modern finance for more than 50 years is based on an optimization framework that is inferior to equal weighting in practice under standard assumptions. You may want to think about that. The dominant theory for the last 50 years in modern finance is based on an optimization framework that is inferior to equal weighting under standard assumptions. Well, isn't all of Quant pretty much, not quite all, but quite a bit of Quant also based on, it's not a question only of the Grinold theory. Well, let's continue. Now, there's a paper in the Financial Analyst Journal recently, and he said, well, what if we can forecast? Maybe we can get rid of the problem of estimation error. Well, David was talking about that. So if we leave the world of Grinold and consider more information, okay, say a 0.2 IC or a 0.3 IC. Now the question here is can anybody ever have a sustained IC of 0.2? And that's a completely different issue and outside of the scope of this presentation, but it's definitely something important to think about. Now, if we do the same thing, but with an IC of 0.2, what you see is that the sum to one bounded budget constraint solutions are a little bit closer to the sign constraint solution. So there's less of a gap here. So clearly more information is better. But in our case, what we see is that equal weighting still beats the sum to one bounded portfolios that are based on theory, okay? And by the way, the sign constraint solution is still far better, okay? And then if we include much more, if we have superheroes here with an IC of 0.3, you know, that would be nice to find somebody who can do that continuously. And then what they would have is the sum to one constraint unbounded solutions here would eventually, after a while, beat equal weighting, okay, and eventually catch up to the sign constraint solutions. So many people might say, you know, there is a slowly rising level of budget constraint simulations. Maybe just maybe if we had enough stocks or enough independent sources of information, whatever that means, and then maybe these unbounded or these sum to one constraint optimizations may work. And unfortunately, the news is not good. It's the slowly rising level of budget constraint simulations is a necessary artifact of our simulation framework. Let's consider the simulation design issues that David had pointed out. Okay, the simulation framework that we are using assumes any additional asset has some additive value. Remember, we do thousands and thousands of simulations, so each one that adds is an average of all of the ones that keep getting added in the resampling process here. Okay. Without anyway, so the simulation assumes any additional asset has additive value. We are assuming an error-free covariance. Now that is an amazing thing that nobody's ever seen before, and a risk model that is perfect. Okay, well, an error-free covariance matrix, which we're trying to make sure that what we do is not, it can't be critiqued in terms of trying to favor our solutions here, greatly upward biases these simulations. And so it's definitely true that many of these simulations that we're talking about without an error-free covariance are probably well buried in the x-axis, okay? Now, constraints often limit the harm caused by estimation error, not what Clark, De Silva, and Thorley said. Constraints limit harm. They add value, that subtract value. If you take some of these ideas and turn them upside down, you get a better answer. And by the way, the costs have been ignored in these simulations, right? So costs of managing a much larger stock universe or whatever, okay, the larger the universe, the more cost managing it. So let me bring all of this hopefully to some conclusion here. We do not contradict the simple intuition that more information and more investment opportunities are useful. That's perfect common sense. The reliable message, however, is different. It takes considerably more than a modest amount of skill to win the investment game, however frequently the skill is deployed, however many stocks or forecast factors that are being used. Under the highly idealized conditions of our simulation study, the results dramatically contradict Grinold theory and practice in terms of the prescriptions. And our simulation studies very nicely generalize all of the really classical simulation studies in the literature, like Jobson and Corky and Frost and Savarino. And they also do a nice job of empirically rationalizing the empirical 1-over results from Michaud. Very nice paper. Okay. For many years, the limitations of law may have negatively impacted many professionally managed quant funds. May have been a significant factor in the lack of demonstrated superiority of active versus passive. If quant has been fundamentally flawed, that's easy to explain why active doesn't be passive. Active done right perhaps can be passive, but active done wrong can't be passive for sure. And I believe this one to be very important here. They may have the limitations of the law may often encourage investing in minimally constrained and overly risky leverage strategies. So the fundamental error, misunderstanding the implications of estimation error and optimized investment strategies, that is Michaud 89. And the nature of investment uncertainty. We have to go all the way back to Frank Knight, 1921, almost 100 years, where he had the right answer for thinking about investment uncertainty. It's no simple roulette game. Frank Knight would definitely agree. Monte Carlo simulation studies should be the framework of choice for understanding the value of optimized quant strategies in practice for the future. So my conclusion, the reliable conditions for winning the investment game is basically what your mother told you a long time ago. It's common sense, right? High quality investable assets. It's not some quant trick. It's high quality investable assets. It's investment significant information relative to a given optimization universe. You must have investment significant information. You need to have economically meaningful constraints. And finally, you must have properly implemented estimation error sensitive portfolio optimization technology. So at this point, I will send it back to Gary, and we hopefully will be able to answer some of your questions. Thank you very much.
Well, thank you, Dick. Thank you, gentlemen, for that excellent presentation. We're going to move it to Q&A now. Now, just as a reminder for everyone who's listening in, on the right-hand side or wherever on your screen, there is a control panel for GoToWebinar, and there's a chat section. And in that chat box, you can type in your questions so that we can present them to our speakers. So we have a few that came through during the presentation, and the first question here, it seems more of a comment. So we'd like to kind of hear everyone's response on the panel regarding the statement. This is a nice extension. This is the comment. This is a nice extension of Michaud's 1998 work that illuminated the hypersensitivity of quadratic programming, or just another term for mean variance optimization, to estimation errors. However, it may not be fair to Grinold and Kahn to imply that simply adding securities or factors results in superior portfolios. I doubt they ever said or believed that. What is your response to that comment?
Well, they did, though. I mean, unless I'm misunderstanding what you're trying to say, I like to take exactly what people say here, okay, and what do they say? This is a quote. It takes only a modest amount of skill to win, as long as that skill is deployed frequently and across a large number of stocks. I do make the caveat that, of course, that it's conditional that the IC is constant as you increase the number of stocks. But what we tried to make is the case that it's not that easy to do. Okay, and there was really serious issues associated with trying to do that, and beyond certain limitations, of course. So I think what maybe Robert or David has something else to say, but oh no, I mean I really went through the both texts, and I wanted to be sure that the invest often quote was there. Okay, so they basically have tried to justify very large optimization universes, and that has happened to be true for many quant strategies. And the problem is that you really can't do that. The portfolios are far too sensitive to estimation error, and the end result is that you can't use a sum-to-one optimization that would allow you to think that for example, a long-short strategy might be better than a sign-only constraint strategy, for example. So there is some, I think our simulation studies try to make the case as clearly as possible, and keep in mind that we're trying to make the solution that we describe here as much as possible tilted towards proving the hypothesis. And of course, we're assuming a covariance matrix that's perfect, which of course makes no sense in practice.
So I would add also that Grinold and Kahn, they present the fundamental law as a mathematical proof, and we don't dispute any of that proof at all. It's a completely valid mathematical proof. but it's just based on assumptions which are highly unrealistic in practice. And so our study is not really contradicting the fundamental law. If you can manage to find a perfect frictionless environment and have perfect information, then go ahead and add as much breadth as you can. But that's just not realistic in practice. And so our study is meant to simulate a more realistic environment. And we have bent over backwards, to be fair, to all of the methods here by giving them the benefit of the doubt, giving them a perfect covariance matrix, as Dick just said. So I think that we have made every effort to be fair.
But to get to the spirit of the question, I think a lot of people do understand that IC and breadth, you can't just keep adding assets forever and assume that it's all constant. But we're thinking about the prescriptions. What is the applicability of this in terms of actually changing your investment practice? So I think we've said that most active managers are already investing in as many stocks or factors as they have good information for. So once you're at that point, you can't really just keep adding more or keep looking for more places to add more without thinking about how much you're decreasing your information, which I think people are cognizant of. But then adding that extra complexity compounds with the estimation error, and very often is going to make you significantly worse off, I think, is one of the cautionary things we're trying to say.
I was wondering if I could follow on that point. When you look at the Grinold-Kahn theory, it's sort of appealing to a smaller size investment manager that lacks the analytical resources and tools that a larger asset manager would have. But based on your conclusions, it seems like that it's the opposite, that if you're a smaller manager and you have a less informational advantage, simply adding more securities to the portfolio or widening out your universe is not going to help you out. So if you're a smaller manager listening to this, what is your approach based off of this conclusion?
One of the things that has always impressed me, as I was a quantitative analyst for a while, institutional quantitative analyst for a while on Wall Street, is what I found is that stock pickers, the traditional managers, usually have a relatively small optimization universe. And it always surprised to me. And I said, when I was trying to write my 89 paper, I was saying, well, why is it the managers don't use an optimizer? For God's sakes, an optimizer gives you, presumably, if you believe the theory, a better way of managing your money and better way of giving value to your investors. But traditional managers don't have a lot, 20, 30 stocks, okay? And each stock that they know, and then they don't put 50, they don't put 200, they put 20 or 30 stocks. And it impressed me that what they're doing was exactly the right thing they should be doing. They were keeping the level of information that they have for every security as constant as they could possibly do it. And then the portfolios that they ended up with, they probably should have still optimized as long as they had an optimizer that might have worked for them. But nevertheless, that was really the right answer. Okay. So what's going on here is that if you're trying to solve problems from much larger universes or much larger numbers of factors and so on, the size of the universe, the number of factors, whatever, the estimation error accumulates dramatically. And what you see here, I mean, I don't know. I think this should be, for anybody on this, as far as I can tell, this should be convincing evidence that the prescriptions in Grinold and Kahn and Clark, De Silva and Thorley and all of the literature associated with this should really be suspect, if not actually contradicted by our results. What we think is that the inverse of what they have been trying to propose is probably much closer to the right answer. But you can't get away with it. You just do need to have information, and you just do need to have good investable securities. You just need to optimize them very carefully, without trying to, with trying to avoid all the mistakes that you can make with an optimizer.
Great. So we have a question regarding the simulation results on Figure 1, Slide 38. And the question is, and I think the person's referring to the green line, shouldn't increasing the IC lead to higher Sharpe ratios, all else equal? Actually, they're probably referring to all the lines, but if you're increasing the information coefficient, all else equal, shouldn't that help increase your average Sharpe ratio?
The IC is assumed to be 1
Yeah,
for the green curve.
for the green curve, it has perfect. This is the referee's information averaging together. So that's the same, no matter what the IC for each panel is describing what the optimizers, what the 3 other curves, well, actually 2 other curves, because equal weight is always just the same no matter what as well. So the red curve and the green curve don't change from panel to panel.
IC equals 1 is what the green curve. Good luck if you find an IC equals 1. Let me know, will you? I'm more than happy to invest with you if you can come close to an IC of 1.
Well, that's actually a good transition to the next question. So an IC of 0.3 seems pretty high, according to this person. Do you have an estimate of what IC is required to make active management desirable? What positive message do you have for active managers?
Well, I tried to make the case here is that I think you need to be aware that there's no free lunch in finance. You should know that. It's not just a simple way of just adding more stocks. It's going to add or more factors. It's going to add into the portfolio. That seems, in hindsight, very naive. Okay, but I think we need to be not just mathematicians, we need to be investment professionals as well. We need to understand what that we're doing here. It's not just pure mathematics at all. So you need information. I know that seems like almost why am I saying that? But nevertheless, I think people need to be reminded that there's no magic here in reality. There's no free lunch. You need high quality investable assets. You need investment significant information. You need meaningful constraints, and you need an optimizer that's going to be sensitive to estimation error.
Great.
I think one more positive message may be that constraints actually are one place where you can, instead of thinking of them as holding you back, you can think of them as an additional way, and that's very intuitive for a lot of portfolio managers, to add information and actually improve performance going forward for your portfolio.
That's actually an interesting point, Robert, and just wanted to kind of add on that. So, you had mentioned in the paper and in this presentation that equal weighting a portfolio eliminates or reduces some of that noise and helps reduce that estimation error. I think the way you described it is that you use no wrong information to distinguish among assets. So with that framework in mind of portfolio construction, how would this apply to a larger size asset manager that is going to deal with a universe of securities that have varying degrees of liquidity?
Well, maybe Robert wants to answer this, but Robert, my answer is that equal weighting, it only works for a little while. Equal weighting just means that you've been doing something that probably you shouldn't have been doing. Okay, that's basically what Jobson and Corky was saying, is that, and what I said in my 89 paper is that optimizers are error maximizers. And by the way, most of you know that it'll probably be on my tombstone, because it tends to be something that every academic references whenever they talk about optimization. And optimizers are error maximizers. But the point here is that, look, I mean, the sign constraint solution is better than equally weighted solution. And so equally weighted is not what we're trying to tell you. Equally weighted is just the benchmark. I think David mentioned it in his remarks, and that is that an optimizer can't beat equal weighting. Why in the world do you want an optimizer that can't beat equal weighting? And that's the optimizer that people have been using And some of the most sophisticated asset managers in the world have been using these kinds of frameworks, and they're much worse than equal weighting.
All right, so just as a reminder for the audience, if you have any questions you'd like to submit, just remember to use the chat feature in the control panel for GoToWebinar. We got time, I think, for another question here. So there's a lot to read through with this question, but basically the question is, this study has enormous implications. As you had mentioned, as a matter of fact, and this is just my comments on this, you mentioned that a substantial portion of the asset management industry has been built on this academic framework. So now, based off of the conclusions in this study, what do you think is next?
Well, I know that I hope I'm not sounding like a broken record, but you just need more you need information, and you need to use it very, very thoughtfully. There's no simple little trick. It seemed like a very nice trick, and that is you didn't really need to know very much information. All you needed to do was keep adding stocks. And so what would happen is people would go to the big pension plans with this very sophisticated approach and this wonderful rationale for adding value to their to an active managed portfolio. But it was based on the assumption that the IC, the information is constant as you increase the size of the universe. And of course, it really is fundamentally negatively correlated. As you increase the size of the universe, you're probably decreasing the size of the information that you have. And so you had these very large stock universes. And I remember some comments by some of the early pioneers of these people who were very good mathematicians and so on, who were using the capital asset pricing model to justify the kind of things that they were doing. And that's, of course, what the Grinold theory is. It's just basically nothing more than a capital asset pricing model with a very clever proof. And nevertheless, it's the capital asset pricing model, and that's not taking anything into account the estimation that is estimation error that is fundamental whenever you use information. See, an optimizer, Harry Markowitz optimizer is wonderful. It's theoretically correct, but when you try to use it with actual data, the data now has estimation error. And the transfer from the theory, Harry Markowitz's wonderful theory, to practice has to do with the fact that how do you manage the estimation error? And I mean, one of the ways you get statistics into an optimizer is to use the Monte Carlo simulation, where you're assuming some kind of multivariate normal distribution. So optimization is not what we thought it was. It's not an algorithm. It's basically statistical estimation. And you need to pay a lot of attention to how much information you have in order how much you ask the optimizer to do. The optimizer is this dumb beast, okay? It'll do whatever you want it to do, except that it might not do exactly what you wanted it to do. So you really need to manage how it works. And that is probably one of the deeper things to say about all of this.
Okay, so I think we got some time to squeeze in another question or two. It's a question from another person who's asking, does this mean that active managers should be more fundamental than quantitative?
I think the answer is probably not the wrong answer, right? I mean, I believe in that. I believe that managers should have a much wider net in terms of the things that they care about. Okay. When you look at some traditional managers that I think one time I was in a meeting and somebody was using various time series of of stock market data, and they were complaining that the time series didn't seem to have much information. And so I raised my hand and I said, you know, there's other sources of information that might be useful for managing a portfolio. And they said, well, like what? I said, well, how about economic data? Does it matter whether, what the interest rates levels are? Or does it matter what GDP is going up, down, or sideways? Does it matter something about what the state of the economy is and the global economy? There's more information out there. And they were very, very surprised that I would ask such a silly question.
I think there's a little more hope for quantitative active management than that, but I think it is saying that you have to do it really thoughtfully. You have to go sort of beyond just looking at a simple model and doing a very straightforward application of that and on a mathematical basis, and make sure that there's a reason to believe all of your data and that it actually fits with your investment intuition.
Okay. All right, great. We'll try to squeeze in another one here. So I think you had maybe touched on this earlier, but this person's asking, why is equal weighting rather than cap weighting used as the naive alternative? Where would cap weighting fall on the chart? And I think they're probably referring to the figure 1 on slide 38.
We didn't want to include various kinds of benchmarks here. Our study is basically just what David said, and I repeated what he had said. But you know, an optimizer that can't beat equal weighting, what possible interest that it could have? Okay, well, it is possible to make an optimizer do better than equal weighting, and what we are talking about here, for example, is a sign constraint solution turns out to be better than equal weighting for a reasonable amount of information. This is a 0.1 IC, right? A reasonable amount of information with a reasonable number of securities. At some point, equal weighting can't do any more. Okay, you expand the universe, and basically there's the information in it. So, but sure, you could, it is possible, and of course this is where the fundamental law came from. It's an optimization of the information ratio. The optimization of the information ratio comes back to index relative mean variance optimization. So we're not ignoring the benchmark at all. Well, basically what we're trying to say is, supposing you have an index relative optimization, whatever the index is, okay, and now how do you want to use that? And so in the mathematics, so the Grinold and Kahn and the Silver paper, they're using that framework. So it is benchmark oriented. We haven't really ignored it, but we're not directly testing it, because it seems to me that if we want something that is just as simple as it can be in terms of trying to make the case of something that maybe for 50 years we've been doing quant wrong. It does seem like we may have been doing quant and even maybe theory wrong for 50 years, because so much of what we do in finance, in applied finance, is use the capital asset pricing model in many different ways. But I think, you know, I think it's something to really think about. It's really something to think about, that the dominant theorem in modern finance for more than 50 years, okay, is based on an optimization framework that's worse than equal weighting. This is a different way of thinking about a lot of things. But what it does is get you back to something that really is quite fundamental, and that is you need information and you need to use it very, very carefully in order to beat the investment game. Otherwise, passive methods, which are really much let's say expensive, may be superior for an awful lot of cases. I think there really is the possibility of doing so much better than what we have been doing. And I think, you know, one of the reasons why what we should be doing is making sure we don't make mistakes, so that we then can maybe do better than what we had before. And that really is fundamentally the theme behind that paper.
So I'd like to add also cap weighting would create a lot of challenges in the context of a simulation experiment, because in the experimental design, the optimizers are receiving simulated data, and cap weights are something that change over time, and with a different set of returns, they would be different for every circumstances. And we wanted to avoid anything that might create any doubts about our experimental design, and open ourselves up to critiques about our experiment. But we really aren't saying anything negative about cap weighting. It's also another completely legitimate benchmark to use for performance.
Yeah, that's what I was trying to say. I think David said it better, but it's independent. The whole issue is independent of what we're trying to do here. And we don't really have a direct conclusion with respect to CAPM. I mean, not CAPM, but in terms of capitalization weighted indices. It's the benchmark that you want to use. I mean, everybody has a different benchmark when they have an active manager, small cap, large cap, whatever it is, international, emerging, whatever. So people have different benchmarks, and how you try to prove that you have the ability to add value is with respect to the information ratio. So the information ratio assumes that there's some kind of benchmark that makes sense to use, and now you're just trying to make sure that the mathematics behind the information ratio makes sense when you try to use it for different kinds of ways of optimizing the portfolio.
All right, we're running really short on time, so we're just going to take one more question here. And the question is do machine learning techniques help to select more relevant factors?
David, you have thought a little bit about artificial intelligence.
If you have a good set of training data, machine learning techniques can do almost anything, but it's all dependent on what data you train the machine learning on. And if you're training any kind of model, I mean, machine learning are just basically very fancy statistical models, and if you fit any model with garbage data, then you'll have garbage results. And if you fit it with highly relevant data to your investment circumstances, you might obtain very good results. But it's hard to know. Regimes can change very quickly, and you don't know if the future is going to match the past. And so I think it's the same set of risks as having a human brain try to do the analysis. So it all depends on the circumstance and the training data that you're using for the machine learning.
And it's a little bit like a back test, right, David? It works for some time period, but what happens with a different time period as well, right? It's to some extent, it's what I call a horse race as opposed to a back test. A horse race is that, oh, well, we just start with 5, maybe AIs or 5 managers or some combination of who knows what. And then let's see who wins, okay? But then the problem with that is that these kinds of things don't really have prospective information. Something that goes back right to, and I really do recommend for anybody who's listening to us, you might want to really seriously rethink Frank Knight. He's been neglected. He's a real genius, and he had so much to say back in 1921. And sometimes it takes a long time for people to get to word. And really what he had to say about financial markets is very deep, and for me, the correct way to think about a whole range of issues here. So, I mean, like the other way to say it is that Paul Samuelson, the great economist there, said 100 years, just another 100 years. It's really not going to tell you what's going to happen for the next 100 years or the next 3 minutes.
All right, well, this has definitely been a profound presentation and research. And just to clarify, this report will be appearing in the Journal of Investing, but my understanding is anyone that's interested in reading this white paper can access it via SSRN and also via New Frontiers website. If they're interested in reading it. So, gentlemen, just any final words or comments before we wrap it up?
Thank you, Gary, for hosting us here. And again, going back to my original comments, we are very, very pleased to be supporting CFA Society here in Boston. And of course, to the Institute as well, and the New York societies and many others that are doing such great work and trying to promote good investment practice.
Well, I appreciate those comments, and thank you everyone for joining us today. Remember to check our website, www.cfaboston.org, to see what upcoming events that we have. Until then, please be well and enjoy the rest of your week. Thank you.
Thank you.
Thank you.